Fund. Samir, good afternoon. Thank you very much for your time. Nice to see you again after a long while. What's your view on the markets? Do you think a healthy-ish correction was warranted, and that's exactly what has started right now? Your thoughts on that?
Hi Ajay, thank you, and thank you for having me, and great to see you guys back. Well, as you rightly said in your forward, that yes, we've had a bit of a wait for this correction for a long time. But I think the right strategy at this point in time is that one should look for where are you likely to see growth return, and that's wherever the pricing is not yet there in the stock price, one should get positioned there. Because even though yes, there will be growth to be had for the next at least couple of years in the Indian market, we are coming back after almost a 3-4 year of virtually famine of earning growth, so to say. So I think once that comes back post-COVID, all the cost structures are completely aligned. And now with the latest budget push, I think it augurs well. So we need to be positioned for the incoming growth that will be unleashed, but need to be very careful about the valuation where we enter, because obviously entry multiples are nowhere close to value zone, at least on the near-term basis.
Fair point, Samir. In fact, the market barely give many on the street any chance to get in the fair value zone from March to September odd period when it was below fair, and the pace of the rally was so furious. So at best what people can do is try to get in at some corrections the way it is happening right now. But let's understand from you which are the areas which you are looking favorably, which are best placed to really capture the higher earnings and opportunities which lie ahead next 3-4 years if this cycle is indeed moving towards a growth cycle.
Well, Ajay, I think if you deconstruct how growth actually gets delivered, I think a significant portion of it is through operating leverage, because most of the businesses today are at a situation whereby you've seen the complete turnover come to a grinding halt in the 2 quarters, which is June and March last year. And after that, as we start recorrecting and coming back to normalcy, once that asset turn goes up, you see, because the cost structures have been so oriented now, that there'll be a substantial amount of operating leverage that should be available from here onwards. Now, if you look at most of the sectors like maybe industrials, materials, consumer discretionaries, now since they are coming out of such troughs, I think that is where you will probably see the demand coming back faster, and hence the ability to deliver meaningful earnings. So I think those are sectors that one should remain aligned to, because from the other position of financials, well, financials one has to dissect it far more specifically, because there'll be certain portions which are more consumer facing, where you're likely to see the credit growth will take time to come back. But yes, the valuations have also corrected. But one needs to realize as to how will the credit growth evolve from here. For example, a 6-7% growing up to a 10, 12, 15, because that's how typically most of the upcycle starts. So financials would be something that one should be definitely aligned to, but one needs to be very selective there. But apart from that, maybe materials, industrials, discretionary, I think that is where you'll probably see a far better delivery of earnings across the board.
How are you looking at or I would say that I'm sure you don't look at small cap, mid cap, large cap in isolation, but your portfolio mix, how much is large cap, and have you started looking at incrementally towards mid and small as well, broader markets?
Well, Ajay, in fact, at Invesco, we run largely value strategies. One is the RISE strategy, which is more of a small and mid, and Dawn, which is more of a large cap. So both of them are essentially value strategies. And I think as of now, as we speak, there is relatively better value available in the large cap space, because we've seen a 3-month of massive run up in the small and mid. But I think that will also, over a period of time, through time corrections, normalize. But as we speak, I can say that as on date, I think large caps offer a far better relative value for the kind of growth that we can see over the medium term.
Samir, the consensus is that the next 3-4 years, there's a very sharp acceleration in earnings. In the Nifty, at the frontline index level alone, we are talking about closer to 800 per share on the Nifty EPS for FY23, and broader markets, depending on which stock are we talking about. What are the risks to this argument in your view? Because the entire market seemed to be tilted in a very singular kind of narrative that earnings is likely to pick up very sharply, and market is very cheap right now, given at 22 or 23 earnings, depending on what you're looking at. What can derail this hypothesis a bit?
Well, Ajay, I think if you deconstruct the Nifty earnings, you will realize that a substantial portion of it would also be coming from a couple of names from where you are likely to see from a loss to profit kind of a situation. Now, if you look at the sustainable earnings, I think by and large, the large components are obviously your financials, your IT, and your energy. I think these three are the large segments from where you're likely to see bulk of the earnings incrementally getting delivered. So I think that is where one needs to be careful as to where you're already pricing in that growth and where there is some growth that is still available, which is still not being priced. I think that is where you need to make your choice, because on the headline number, you're absolutely right. I think at a 800 kind of an EPS, that probably masks a lot of things. So don't look at index or index earnings, but go very stock specific. And that is where I think the large cap today gives you far better relative bang for buck than perhaps the small and mid at this point in time.
Right. Fair point. Samir, at your PMS, what kind of conversations are you having with your HNI clients all across? Is there eagerness to invest more, or because at least the mutual fund side continues to see redemptions. SIP is very healthy at about 8,000, but overall there is some amount of profit taking there. What kind of flows are you seeing, and what kind of conversations are you having with HNI investors across the country?
Well, I think most investors that we are in touch with or wherever we interact, I think for them, they have taken a far more nuanced approach towards equity investing now than perhaps in the earlier cycles. So therefore, they are far more eager to know what kind of stocks you own, what is the kind of outlook you have. And because we run essentially value strategies, there is additionally that bit of comfort that we don't essentially buy something that is price or momentum. So we would typically be looking for value in a market that is right now completely on a growth steroid or growth expectation mode. So to that extent, there is far bit of comfort in the extent that the mandate should be in a position to deliver better return outcomes. And in fact, even in the last 6 months, I think give or take 25-30%, both our value strategies have delivered similar kind of returns. So we are pretty happy to say that despite it being a complete growth market, the portfolio is delivering on the value bias, and hence we believe that value will come back. And I think most of the investors are also pretty consistent with that view that they would look to remain aligned, and they would like to see more proof of the styles getting more exhibited in the way the market is also reacting now. Because after the first move from the COVID lows, probably after say September, when we started seeing a bit of pickup in the flows, etc., I think you have seen the first move of growth expectation and the build up towards FY22 and F23 numbers going up, and hence the market moving from September to date. But now, as we speak, yes, there is again the scare of maybe a second wave, etc. So people are slightly, taking a more measured stance. But I think the value will still come back in play, and that's what we are hopeful with, and that's our investors also are pretty consistent with that.
Samir, you're also somebody who reads and observes global macros and cues also very closely. There is fear of the global yields rising or rearing their head once again. Do you think that there is a big risk to that, or the global liquidity scenario may remain benign for some time before any reversal or any early sign of reversal may actually happen? So one should read it carefully.
Well, Ajay, you're absolutely right. I think the way the US yields have been moving, at least in the recent past, very, very clearly have been a sort of a discomfort at the margin. But I think, from a systemic risk mitigation point of view, I think most central banks would be, aware of the risk in case of there is a premature or faster than expected withdrawal. So markets will be prepared, as to how and when the normalization happens. But I think till that time, this whole, fear of inflation, etc., I think that is what is perhaps causing a bit of a discomfort in the minds. But, net, we have to look at what is relevant for India. I mean, we get $3-4 billion kind of a flow on a month, and then suddenly your markets goes ballistic. I think so at the margin for us, it is the direction of flow that is important rather than the absolute quantum, because quantum, if it maintains this way, I don't think there's a massive risk to us on the downside. But if the direction remains positive, then I think we are good to go. Because at the end of the day, India is a very credible growth story, and from an overall investor allocation point of view, India is not as much owned as perhaps maybe a China or some other Asian market. So hence there is obviously a propensity that people want to understand that given the fact that now what we have done with even managing the pandemic, I think we've done a decent job. Our fatality rates are low, our recovery rates are high. Even in our stage of inoculation, we've ensured that 9 million people have already been given the jab. So to that extent, India has done a fair bit for us to be standing up and getting counted in the world scheme of things. So I think from that perspective, interest in India will remain high. Flows in India will come. It's just that we need to be sure as to what are we buying and what are we expecting on that for the next 2-3 years. So I think that is where every individual investor should take that call, that in a growth market, you need to be sure as to what are you pricing that growth for, and hence, in case there is even a quarter or two sort of a slip up in terms of the time frame of the expectation, is there a downside to valuation? So that's how you need to make your choices.
Right. All right, Samir, we'll let you go on that one. Thanks so much for your time today. Time for a very short break. On the other side of the break, we'll get you some more stock-specific news and analysis. Don't go anywhere.